Yeah. All right. Welcome everybody to live stream. My name is Kyle Seagraves. Here with me is Dan Frio, as always, and or Dan Frito, his alter ego.
Yep, my alter ego,
That's
yes.
that's the housing crash. Alter ego is Dan Frito. Um, how you doing?
I'm doing awesome. So why are you tired, Kyle? It was that late night partying last night watching the debate, huh, buddy?
I certainly wouldn't
We were
call it a
talking
party.
off
I would,
we were talking off camera. It's an inside joke. So
yeah, I wouldn't call it a party. It was much more of a let's get drunk so we can watch the debate in some sort of semblance of peace. Um, Cool. So thank you all for being here. We're going to answer your questions. So leave those in the chat. Also, let us know where you're looking to buy. You're welcome to leave like a state or a city if you want to. Both would be fantastic. We just want to get an idea of where you're looking at buying, because I think we found we don't often work with people who are in like these super intense markets. We're really work with a lot of people in the majority of the U.S., which I think tends to be like smaller metro areas or smaller cities. So we'd love to hear where you all are at. And today, what we mainly want to cover is what you can kind of expect if you're looking at buying this fall. We're mainly going to cover home buyers, not home sellers. But if you're looking at buying this fall, what to expect? Because I think there's a lot of information going on around what everyone's anticipating happening with buying in the fall, getting into winter, and I think there's a lot of bad information and a little bit of misinformation around what's going to happen with rates and prices and things like that. We want to cover what's going on with rates, the Fed rate cuts, things like should you buy points, maybe look at refinancing in the future, and then also things like timing the market. A lot of people are trying to play, super investor to time the market correct, and so we'll cover that as well. So we already have a couple people in here. We have oh, that mean bean got here just in time. Thanks for being
phew.
here. We have Leviathan. What isn't that like some sort of creature? What's a Leviathan? Do you know what that
It's a
is?
person's name that's watching us right now on YouTube.
That's true. I didn't mean to call you a creature.
I
Oh
told you don't
man.
day drink, buddy. Don't day drink.
Oh man. Um, Rakesh is in here again. Thank you for being here,
My
Rakesh.
man.
The best thing that never happened. Looking and buying in Hawaii. Rakesh is joining in from Howard County, Maryland. Let's see. We have Panama City Beach Bum looking to finance a construction to permanent loan in Apalachicola, Florida. Is that how you say that? Like
Apalachicola.
Appalachia
Yeah.
and Pensacola
You know what?
combined?
I just did a VA loan there, and I kept referring it to the Appalachian, Florida, or whatever. But yeah, I know where that is.
Huh.
There's some people in here from Florida. I see Kissimmee, Florida, and so forth. I love to get their intake on what the
Tampa.
heck's going on with real estate in that area. Derek, please
I
stay
would
with us
love
just a little bit because I'd love to get your context and what the market looks like.
And I'd love to know too the insurance world, if you've been shopping for insurance in Florida, how that has been as well, because that's been a bit of a mess. And my cats are doing a nice little scuffle over here, so that's super fun. We have Austin, Texas. Amanda, thanks for being here. A Leviathan is a sea monster. I knew it was something. Let's see. We have Anna's in Cleveland, Ohio, looking in Kissimmee, Florida. I think so you say that.
Yep.
Panama City Beach Bum said maybe a VA lender.
We can help you with that.
Yep, absolutely. Jennifer. Hey, Jennifer. Thanks for being here.
Oh,
Good
and
to
like
see
what
you
she's
again.
saying too. Over 40 watching, hit that thumbs up button. That helps us, folks. All the help. We'll take all the help we can get.
Virgin County, New Jersey. Cool. You want to jump into a couple questions first, and then what we'll do is we will get back into this article, talk about buying in the fall. Before we jump into questions, though, I should probably tee it up to you. Do you want to talk about what's going on with interest rates currently and where they're at?
Yeah, and it's pretty awesome actually. Every day they're dropping like point 0.2, point 0.1, point 0.2, point 0.1. Over time, I quoted or actually had an FHA loan I just submitted. I got 3 contracts in so far today, and 2 are conventional. One's FHA. The FHA one is actually, we priced that thing in the 5s. What's it up? Yes, look, the 5s. Yeah, I ran it. Then I had to run it again. Then I had to run again. I'm like, whoa, whoa,
to
we're in
make
the
sure it was
fives.
real.
So it was kind of a shocker because it's like, I even had a conventional loan in the fives that they were paying like a quarter point or whatever to get them at 5.99. So it's pretty awesome to see that. So here's what has come out over the last, here's what's coming out in the next 24 to 48 hours. What we just got this morning was the CPI report. And if you don't really understand what that is I'll break down two pieces of the puzzle for you guys. So today we got the CPI. Tomorrow we get the PPI. Okay. Think of the C on the CPI as consumer inflation, or C is for consumer. P is for producer. Okay. So today on the inflation side, we saw consumer inflation actually 3 out of 4 numbers dropped. One dropped pretty considerably, but one went up 1/10. So let me explain them to you. Some of the numbers are going to say core. So it might say core CPI. So what the core means is they're pulling out, they're taking out food and energy. And you guys know how I get kind of pissy about oil prices. Okay, perfect. Okay, so what you're seeing on the screen right now is the top one says core CPI MOM. And then you got below that CPI YOY, CPI MOM. So what that is core means they pulled out or they stripped out food and energy prices. Okay, because they're hugely volatile, especially gasoline and oil. Okay, that number was the only thing that surprised on the upside. All right, you had the month over month. When the previous reading was 0.2. All the economists expected it to come in at 0.2. It actually came in at 0.3, just a little bit hotter than expected. Now the good news is the year over year. Look at the one right below that, CPI year over year. The last reading was 2.9. It dropped all the way to 2.5. So you would think that that'd be like, okay, inflation is coming down. That's almost 0.5% down. The markets didn't react. They reacted to the core piece of this equation, and MBSs, and I'll put all this in the context for you guys in a second. The MBSs just plummeted. They dropped like 20 points right out of the gate. What the MBS market is basically it's telling us, it's the bond market telling us what direction mortgages are going. And if you know anything about bonds, as the price of the bond goes down, the yields go up. Okay, so when this CPI print came out this morning, it was like, I looked at the numbers, I'm like, it's pretty good actually. But the MBSs, well, mortgage rates shot up, and I'm like, this doesn't make any sense. Well, since then, the MBS market is completely flat at this time. So it absorbed that data pretty nicely, but I thought we'd actually I thought it was a good print because the year over year went from 2.9 to 2.5. So that's the news that we have today. Now, tomorrow, what we're going to get is the PPI, the producer inflations numbers. So usually the CPI has a bigger impact on mortgage rates than the PPI, but only time's going to tell. And then the other piece of this equation is the initial jobless claims. So they're expected to be completely flat. I'm also a contrarian in that area too, because I think that number is going to come in a little bit softer than expected. So what you have to understand is, why was the Federal Reserve created? Okay, you might hear me say a lot of times there's 2 mandates. They were created for 2 mandates. They were created to control 2 things: inflation and employment. Okay, so the inflation is they're controlling it by what they're doing to rates, and the jobs report is right in line with what they're looking at too. So the jobs market right now is getting weaker and weaker and weaker, and that's their biggest focal point right now. So tomorrow's PPI number is going to play a big role, and also the unemployment rate or the employment numbers are coming out tomorrow. So tomorrow is going to be a huge day, and then on Friday there's nothing. So tomorrow we're all just sitting on back, and I thought the markets would basically be flat, waiting for the PPI print tomorrow after the CPI print today. But it's just a weird market right now. Like this morning, the Dow Jones was down quite a bit. And if you go down to the major indices now in the equity markets, you have the Dow Jones up 60, and you have the NASDAQ up almost 300 points. So it's just a confusing market right now. And I think everybody's just sitting there saying, okay, what's the Fed going to do? And that's why in my videos each day, I'm trying to figure that out to give you guys direction on where rates are going, because that's going to ultimately flow through to what real estate does in the rest of 2024 and 2025. So that's it, basically.
Awesome. Nice summary, Dan. Thank you for that. Let's go through a couple questions here. Leviathan, the sea monster. Good afternoon. I have a question. If you got the flow down option and you're closing on September 20th, can you still exercise that option after they send you the CD, typically 3 days before closing? Yes. So a new closing disclosure doesn't have to be sent out if that rate decreases. Basically, if your APR on for your loan is going to increase, I believe it's an eighth. A new CD has to be issued, an eighth of a percent. Then a new closing disclosure has to be issued. If it doesn't change or it decreases, then usually a new CD doesn't have to be sent out. However, a lot of mortgage companies still will send a new closing disclosure, and they can run off the timing of the previous one since the rate decreased. So it really just depends on whatever mortgage company has this float down option. Usually there's some terms with it. So it's not unlimited, up until the hour before closing. I would contact them and see kind of the latest that you can get that changed, because it really is going to be a company policy thing as opposed to a federal regulation type limit there. Oh, they said they want to exercise it on September 18th. Dan, that might tee up a little bit of, you want to jump into what's happening with the Fed rate cut and that kind of the whole idea of it being baked in with rates?
I'll prompt up to this. Why would you wait for the 18th to do that buy down? If you wouldn't mind just posting your comment real quick, if you're still with us, I'd love to know that. And we'll wait for just a minute here. While we're waiting for the comment to come back, the Federal Reserve is meeting next Wednesday. We'll have a live event Wednesday as well that day, telling you what they did, what the projections are, what the guidance is. So here's I'm going to answer this question. Hopefully, he might pop in there, but you're wanting to exercise that option on the 18th. And most likely the reason being is that's when the Federal Reserve is going to come out and tell us what they're going to do. It doesn't work that way. It doesn't work that way. So if you're watching this video, please, when the Federal Reserve cuts rates, you don't have to wait for that day to do anything. Okay. And here's why. Kyle actually brought this up at the last live event. What's that?
Just they said, I heard there was a big chance to cut rates on September 18th.
Okay. So that's what we thought. That's what we thought you meant. So Kyle had the perfect analogy to this. Okay. So here's how rates are working. Okay. So on the 18th, the Federal Reserve is going to come out and tell us exactly what they decided to do, or they're going to basically tell us all the news. Okay. So here's Kyle's analogy, and it was genius. Let's assume this is Apple coming out with their earnings on the 18th. Okay, so on the 18th, they're going to tell us exactly where their earnings came in and all this other stuff. But this week they come out and they're like, okay, our sales are bad, our earnings are going to be bad. Everything is really bad right now. Well, you're probably not going to wait to sell that stock until the 18th when their earnings come out, because that's just going to validify that their numbers are going to suck. You're going to sell right then and there. Okay. So that's what the markets are doing right now. They're taking all the data. And that's why I do my videos every day, to give you every day's data that's coming out and how that will be a determining factor for what the Fed does at that later part. But what they're doing is, as we're monitoring these numbers, the Federal Reserve came out and said, okay, inflation, we're okay with inflation right now. We want it to continue to drop, but our biggest concern is the jobs reports. So now we're changing our focus. We're still continuing to watch the CPI and the PPI and things like that, but we're putting a little more focus in on the jobs report numbers, and the jobs report number is going to come out tomorrow as well. So what the markets are expecting, they want weaker numbers. They want weak, they want the inflation numbers to come down. They want the jobs numbers to come down, less people working. That's going to play right in the role of where the Fed is, because right now the economy's overstimulated and the Fed is trying to cool it down by raising rates. Well, they've raised them up, exponentially over the last 2 years. Now everything's kind of topped out. So now their thing is, okay, inflation's coming way down. It was at 9, now it's at 2.5. And now we want to be concerned about the jobs market to make sure that we don't go into a recession and tons of people lose their jobs. So that being said, you don't have to wait till the 18th. To lock in at that point, because it's already going to be it's already going to be news. The data is already going to be there. But what you want to focus in on is focus in specifically tomorrow on the jobs report, the PPI number tomorrow, and then we want to focus in on what the Federal Reserve's verbiage is. And on next Wednesday, we're going to come out and tell you exactly what it is. And we actually outline their transcripts and tell you, is there any differences? What are we seeing here? Are they potentially going to decrease rates a little bit more or a little bit less? Kyle, can you queue up the CME FedWatch tool? This is a report that I go over daily on my videos, and it's a little intriguing. Kyle and I were reviewing this just before we went live, and here right across the top where his arrow is right now, it says 500 to 525. That's a percentage. Okay. So with that number is in there, that's 5% to 5.25%. Okay. There's an 87% probability that that's where the federal funds rate is going to be at the next Fed meeting next week. Okay. Currently, it's at 5.25 to 5.5. So that means the Federal Reserve's most likely going to cut 0.25%. Now, here's where the change has come just from today's CPI print. The number now, there was a 68 probability that the Federal Reserve at the November meeting was going to cut rates even more, the 450 to 475 bucket. And now that's gone. So now they're saying there's going to be most likely 0.25% cuts by the Fed. Now, I've been predicting that. I said they're going to cut 0.25 this time. Then they're going to be completely dependent on the data again, because inflation's kind of, the CPI report came in today at 2.5 from 2.9, but we're concerned about the PCE and some other things. So it was a fantastic print, but there was basically just a variance between the month-over-month core inflation reading. So again, what I'm trying to explain here is, don't wait for these dates to be that day where it's like, I'll lock on that day, because that day is when the Federal Reserve is going to cut rates. The Federal Reserve controls the federal funds rate. They don't control mortgage rates. So mortgage rates are going to continue. Just look at it this way. Mortgage rates they're down, 0.5% over the last couple of weeks. The Federal Reserve hasn't done anything yet. They haven't even met. So that's what that should show you, kind of rates change, every day based on the news and the data. So I'll leave it at that, because I don't want to get too in detail. We'll lose everybody. But
I like it.
Hopefully that makes sense.
Julio said, I'm looking at putting in an offer on a home here in Florida in the Broward area. With inventory climbing, debating offering less. The list is $469, looking to offer $450. Curious to see what you guys are seeing. So what I did, what I think is best in these situations, is we like to look at a website called Altos Research. And so basically what you do is you can go to altosresearch.com, go to product market reports, and then you can run a report here. So I did this for Fort Lauderdale because I believe that's the similar area, or where most people are looking at buying in the Broward County area. So what it will do first is show you, is this a buyer's market or a seller's market? So this is kind of pretty much right on the line here. This market is kind of in that tipping point territory where they say a slight seller's advantage, but we're talking, 2 points on this 100-point scale in a seller's favor. So if in any market around this area, this is giving a good indication that maybe now you might have a higher chance of being able to offer less and make that offer stick in an area like Fort Lauderdale. Another thing that you can take a look at here is the price decreases here. So basically, as the price decreases increase, that means there's more sellers that are reducing the price of their home. And so that's a good indication that you could offer less, because sellers are already lowering the price of their home. So you might be able to come in offering less because those sellers are maybe feeling like their home is sitting on the market for a little bit longer. So for instance, one of the things you might look at is average days on market. Since the beginning of August, so about the past month, average days on market in Fort Lauderdale has increased quite a bit. There's been a nice little spike up here. And then also the price decreases. Normally, most markets in the US are around 30% on average of price decreases. And so we can see there's actually quite a bit of an increase that's been happening this past year. This is, let me get back to January. January is right here. So this has been steadily increasing. So I think your hunch is correct, that you might want to go ahead and try to capitalize on what's happening in this market here. I'm curious to take a look at these market segments. You were looking at 469. So you're going to be closer to this bucket here. What's interesting is that's the more competitive aspect of Fort Lauderdale. Maybe I can zoom in a touch here. So this is breaking the market segments into 4 evenly sized segments. So the high end of the market is 4.3. The next highest is 1.2. The next is 700,000 and then 450. So you're kind of around this fourth bucket here. And so what I'm looking at is basically new homes that are listed versus the ones that are purchased, and then the days on market. So the hard part is, even though you're seeing all of the data showing it's very likely you'll be able to offer less, this is the most competitive group of homes in that market. So I would just keep that in mind. Maybe try going with that 450, but then keep it in mind that, if I was in this market, buying in the $700,000 plus is going to be a lot easier to get those price reductions in. I'm not saying go and buy a $700,000 house so you can get a price reduction, but just keep that in mind that the data is largely reflecting $700,000 plus for this data versus that bottom quarter of the market.
Cool.
Let us see some other questions in here that we have.
Hey, Amanda.
Yes, we also do VA loans as well. Love for Puppy said, is the PMI higher on a refinance than a purchase? No, it's not. They're going to be extremely similar to each other. There's not different risk factors with a refinance over a purchase. Carlos said, good day, fellas. I close on my property in Green Valley Lake, California. I close tomorrow, and the property is in the San Bernardino Mountains. It's currently on fire. I just insured with USAA. Man, that is awful. There's are you familiar with the Watch Duty app, Carlos? There's a really cool website that a friend of mine knows some of these people who made this app, and it basically reads all the fire reports and then shows you a map of all of the different, I don't know what to call them, fire zones. Wildfire map. That's probably the better way to say it. It's pretty cool. But I am sorry to hear about that. That's terrifying. Hi from San Antonio, moving to Denver, and I've been watching for a few weeks/months. Cool. Thank you for being here. We have Dallas in here.
Amazing how people are moving all over the place. That's kind of cool.
Carlos said, are you guys familiar with the California Fair Plan and the DIC? If so, can you please elaborate on it a little bit? That doesn't ring a bell at the moment. You're talking, okay, the fire insurance plan. I'm not super familiar with it. That might be something I'd have to look into to be able to comment more on that. Just Me said, hi, we're looking to refinance and not sure how much longer to wait for interest rates to lower. We'd be using VA. Any suggestions on waiting, and also your thoughts on a VA? Earl, thank you. Go for it.
If you have a VA loan, just reach out to us. And Kyle, if you can put up my email address, just reach out. Let me know. You can send me your mortgage statement, whatever you want. What I'll need to know is, just some basic information. But if you can email me, just ask, say, hey, Dan, I'm the person on the live stream that was talking about VA. I'll guide you in the right direction. I just need a little bit of information from you, and then I'll give you a quote, and then I'll give you my feedback on where rates are going from there and so forth. So love to work with you on that one.
Nat Kikuna said, I was going to say hello, gentlemen, since gorgeous flusters you two. Now looking in Sholo, Arizona. Awesome. Yeah, don't call us gorgeous. Don't do it.
I like it. Don't speak for yourself. I love it.
Rational 35 said, I'm a realtor 2 hours west of Fort Worth. It's been a buyer's market for months now. It's stressful for sellers and buyers. Interesting. It's a buyer's market over there. Huh. I'd love to hear more about that. Amanda said, when they say you can refinance after 6 months, that's 6 mortgage payments, right? Not 6 months after closing. Yeah. And I think there's a little bit of confusion around this too, because if you're looking at like a standard conventional rate and term refinance where you're just refinancing just to lower the interest rate, you don't have to wait 6 months. Same thing with actually FHA loans too. Like if you're getting a normal refinance, think like an appraisal, a credit check, full underwriting, just like when you purchased, going through the whole process. You don't have to wait 6 months. The 6-month wait period is only for certain types of refinances, and that would be streamlined refinances. So, for instance, an FHA streamlined refinance or a VA IRRRL, that's also a streamlined refinance. And streamlined refinances are, think about, it's streamlining the process. So an appraisal isn't needed. You don't need to have there'll be a credit check, but it's just to make sure that your mortgage payment has been paid on time. And then there also aren't checking like your income and things like that. And so it's a much easier, streamlined process that requires the 6 mortgage payments at minimum to be able to qualify for those. And then with a cash out mortgage, that's also going to require a waiting period as well. So, but if you want to refinance earlier than that, you can still do that. It just requires the full underwriting package with, the appraisal, income, credit, things like that to be able to qualify. Rakesh said, how much does location impact interest rates? I got an unreal deal for a 15-year fixed, and I don't understand how it's so far off from the average rates on Mortgage News Daily.
Usually no. Every once in a while you'll get some lenders will have, if you're in this state or whatever, there might be like a 0.1 something or whatever, but usually the rates are right there. You're getting 4.75. How's that compare with the rates right now? That's like crazy. Yeah, that's like
right now 15-year conforming
below.
is 5 points.
You might want to just be careful that you're not being kind of duped. So Rakesh, if you want to email me your paperwork, just so you're like your loan estimate or whatever they provided, I'll take a look at it for you and just see if there's something in there that just seems odd, but it does seem odd, just putting it that way.
And we do have a way that you can do that. If you go to the website, Win the House You Love, and click Tools, and then compare your quote, you can upload your quote or loan estimate there. And then Dan will actually record a video and send that back to you, showing, reviewing your quote. And then we can also show you what we can offer there with it side by side. It makes it easier than having to go through a full, application and doing the whole deal there. So we can take a look if you'd like. Love for Puppy said, do you always need to wait 6 months after purchasing to be able to use the new higher appraisal if you remodeled? To do what? To like remove PMI, is that what they're saying, or to be able to cash out?
They might just want to base it off of the new value. It's kind of tough. Usually you have to wait a year to use the new value. You can have an appraisal done, and you're going to have to document the work. It does get challenging,
is this to remove,
but it's probably worth the effort.
Is this to do what?
Just to refinance.
Oh, I guess why would they need to do that without? I guess I'm confused on why they would want to use the higher value.
It might help. It might help on LTV, reduce their PMI.
Oh, just to lower that a little bit.
Yeah. So they might have bought it for like $200,000, put $50,000 in. Now it's worth $280,000, $300,000, and it could be substantial, or there might not be anything there. So yes, email me your just email me the kind of the gist of what you're doing, and I'll help you with that. I promise.
Crypto Cepido said, hey guys, I was outbid and priced out the market in 2021. With interest rates going down, do you think we'll be heading back to that type of market? Looking to buy sometime November, early 2025. I doubt we're going to see that same level of intensity. It's very unlikely that that's going to happen. In my opinion, I feel like the people who bought during that time kind of satisfied that intense demand. I think there's still a lot of demand.
FOMO.
Yeah, a lot of demand for homes still.
It was like, here's my thought on it. The rates were so cheap. I mean, it's basically like you're buying your house with almost free money. They're financing, and you got to think of it. It was 30-year money at like 2 or 3% interest rates. It's unheard of. So I don't think we're going to get that much euphoria. But if you sat at my desk, I mean, I personally got 3 contracts in so far today, and I don't write many loans. I usually do this. Me and Kyle are the marketers, and we work in the back rooms and stuff like that. Helping bring in the business. I mean, we work behind the scenes and whatever, just trying to bring in the business. But yeah, there's pent up demand, and as soon as rates get to a point where people that those payments are a little more affordable, I think you're going to see the euphoria again. But we're coming into that time of year where things are going to cool off anyways. So I think a lot of people are on the sidelines waiting for that, maybe the housing crash that never was to be, or the rates coming down a little bit more. Because it's projected that the Federal Reserve is going to continue to cut little ease and ease and ease and ease. So, but I don't think it will ever be back to where we were back in 2021. That it was nuts, even on the mortgage side of the business. So will it be more competitive? Yes. But again, we're getting in that time of year where the cycles slow down anyways. So I don't know if I'm answering your question precisely, but I think I would stick my toe in the water now before rates get into the fives, and then you have the masses come to the table.
Yeah. You're not on the internet chronically as much as I am, because this is what the back rooms are, Dan. This is like it's like
you ever watch Boiler Room? You ever watch the movie Boiler Room? Come on.
Oh, not the DJ set Boiler Room?
Oh, it was like the stock market. The traders and stuff. If anybody watched the Boiler Room, give me a thumbs up if you've seen it. That's what it looks like, because they were doing a whole bunch of fraud, stock stuff. It's an older movie. Van Diesel's in it when he was younger and so forth. But what happened was, it was a big brokerage firm, and then they knew the feds were coming in, so it went from this big room to it looked like that the next morning when the feds showed up. They already cleaned everything out. So sorry.
Okay. It's only on VHS, is that right?
I think it's on beta. I'll go back even far. Well, you wouldn't. And never mind. I remember back in the days when like CDs first came out. They weren't CDs like this. They were like freaking albums, and they were called, I forget what they were even called, but yeah, whatever. Okay, we'll move on.
Well, this may be a good time to transition to the second part of this article here is talking about, kind of that thing with timing. I know in the last stream we talked about this a bit, where a lot of people are feeling like they have to time the market. I have to get in at the right interest rate, and I have to get at the right price, and everything has to work. And I think the main issue around here is, unfortunately, the way that a lot of people talk about buying your first home is that they're trying to convince you that it has to be this investment, that you have to make a lot of money off of it. And there definitely is a fine line of making sure, okay, with home prices and the monthly payments being very difficult to afford for a lot of people, that, yeah, you want to try to make, buy a home that's as affordable as possible. But I think too that a lot of people are trying to maximize it as much as possible, to the point where it's just impossible to predict what's going to happen with the market. It's like with any sort of investing, kind of the golden rule is like, don't try to catch a falling knife, meaning that, if stock prices are going down, there's a lot of people who try to wait it out to get to the bottom, as if the bottom is just going to present itself and say, here I am, we're about to go up now. It's just not how any market works. It's really unstable. And if anyone could predict exactly what's going to happen in the future, we would all be rich if that was the case. It's just no one's able to predict with that level of certainty. And so I would just encourage, if you're looking at buying, not feeling like you have to make the best decision or that there is a right or wrong decision. Nobody knows. Unless you're looking back at history, nobody knows exactly what the right decision was to make in that time. And so what I like about this article is talking about making sure that you're not trying to overly time things, right? We're not trying to time exactly when rates are going to hit their lowest in the next 2 weeks, because we talked about this on a previous stream too, is I know someone was kind of debating, should I lock or float or wait for things to drop in the next, it was 10 days. Well, rates are likely going to continue to decline over the next year, possibly 2 years, to a place where you're going to refinance. For most people who are looking at buying now, odds are you're going to be refinancing in the next year or two. And so I don't think it's worth the stress and the frustration and all the second guessing to say, should I make sure I get, can I wait a little bit longer to get an eighth of a lower rate, versus moving into something that's comfortable for you and then refinancing as rates continue to decrease in the future, I think is a much better plan, because I'd rather get 1% interest rate lower than focusing on 1/8% and then having to refinance anyway in the future because interest rates are still going to continue to decline. So I think a lot of people are just feeling like the stress around like, I have to time it perfectly. I have to wait till the 18th to get this better rate and things are going to click and it's going to work really well. And no market has ever worked that way. And so really, I think the focus should be on moving into a home that's comfortable and affordable for you with where it's at right now, planning on that for the long term, and then waiting for refinance opportunities to come into play. And then when we see those refinance opportunities, likely in the next year or two, or possibly even shorter than that, then taking a refinance to be able to help lower your interest that you'll be paying total and the monthly payment as well. I really think is going to be kind of the better plan for a lot of people.
And the good news about what you're saying, though, too, is it's not, about 2 years ago, well, it's not like we're assuming that rates are going to come down. In this environment, the Fed has come out and said, we're cutting rates. So it's not that, I hate that analogy, what is it? Date the house, buy the house, date the rate, or something like that.
Marry the house, date the rate is the
thing. So I'll put it this way. If you love the house now and you can afford it as is, and it meets your financial needs and everything else, do it. If it doesn't, don't do it. And then refinancing, that's only kind of a straw in the cap, is if you can over the years refinance and drop your payments, lower your payments. How many times has your rent gone down over the last 10 years? Probably never. So what the refinance will allow you to do is it'll allow you to decrease that, because what's going to happen is this. Your real estate taxes are going to go up every year. It might go up a little bit. In some cases, it might go up a lot. Same thing with homeowners insurance. So your overall monthly payment is going to increase every year a little bit. Okay, by refinancing, it allows you to kind of reset that down to a lower payment. Again, compare that to what you're paying in rent and how often does your rent go down. So I'm not going on one way or another. We're just trying to answer the questions. But I don't like FOMOing home ownership, but I've owned a house since I was 23 years old, and I wouldn't have it any other way.
Sweet. Okay, we'll get into some questions here in just a second. I do want to. There we go. I saw the little mute thing come up. Not sure why that happened. Anyway, so really quickly want to explain what we do, and then we'll jump back into some questions here, and maybe we'll do a little speed round. But we work in all 50 states. Dan and I are both licensed under ServBank, and we work with a small team of mortgage advisors. So what you can do is you can go to winthehouseyoulove.com and schedule a call if you'd like to get started on getting pre-qualified for a loan. Getting pre-qualified is the first step before you start shopping for homes, because you have to figure out first, can you qualify for a loan to be able to buy a home? And then also, what do those numbers look like? And what we can help you do is figure out the monthly payment that you can qualify for and what kind of home price that would relate to. That way, when you go and talk with a real estate agent and shop for homes, you know exactly the constraints that you're going to be looking at. That way, you don't make the mistake a lot of people do, is they just kind of scroll on Zillow, they find a house, and they're like, I think I can afford it. And then they try to scramble to get pre-qualified, and then it's stressful, and they're down to the wire, they have deadlines, and then they get the payment quote, and they're like, whoa, this is way higher than we thought it was going to be. And at that point, a lot of people feel stressed, and they kind of move forward with it anyway. So it's better to be planned before you do that. That way you don't rush through the process and end up making decisions that you're not really comfortable with later on. So what you can do is schedule a call, and there's no obligation, so you're welcome to ask us questions. Similar to how you do on this stream here. And so you'll be talking with either Dan, Alan, or David on our team. Each have over 20 years of experience. Then we'll have you fill out an application that takes 10 to 15 minutes. We'll show you your quotes, and then you can shop for homes with a real estate agent. So if you're ready to move forward, you can go ahead and go to winthehouseyoulove.com. Again, it's free. There's no obligation with it to purchase or do anything like that. And we're also not going to sit and call you all day like a lot of lenders do. That's not fun for anybody. So we'd be happy to help. So let's jump back over here.
Cool.
Let's see. Graphic said, "Hey Kyle and Dan, thanks again for sharing your wisdom. You guys are awesome." Thank you. Appreciate it.
Hey, thanks.
Tiara's here. Hey Tiara. Looking at Austin. Let's see. Leviathan said, "I see we're able to float down 0.25 or lower. We'll exercise it as soon as it goes down some more." Awesome. Good plan there. Okay, let's see what other questions we have in here. I'm currently buying a house in Texas. Houses are cheap and abundant. Am I buying in too early? House is $265, down payment 3, conventional loan at 5,875. Buying too early. I'm kind of curious what you mean by that.
No, I mean all the details you're providing right there. If the houses are plentiful, you like the price, the down payment. That's the first time home buyer program for the down payment and conventional loan 5,875 is fantastic because the 30-year fixed average right now is 6.125. So the only thing I would caution you on is the 5.875 is if you can maybe email us your loan estimate, we can review it to see if there's a bunch of fees in there you just didn't even realize. Because that rate, I can almost assure you that's a conventional rate. There's probably some points or some major fees in there. I could be wrong, but most likely that's because your rate is way under market price.
Swift Medic said, "I've been saving for approximately 10 years to save for my first house, and I didn't buy down any points either." That's awesome.
Fantastic.
Sneak Attack said, "Shout out to Dan. I started watching his videos daily and always learned something new about the market. Very informative, and everyone should check out his channel. Keep up the great work." Very nice.
My channel is much different than Kyle's. Kyle educates you guys on mostly programs, what programs we offer, and if you're a first-time home buyer, what you should do and everything. Mine, I do it every day. I'll drive you nuts. I do one in the morning and the evening. I do the opening bell, and they're like 8 minutes long. And I tell you what the economic news was, what rates did, what the equity markets did, and what my projection is, or give you some forecasts. And then at the end of the day, we come back and say, okay, here's what the markets did, here's what's coming out tomorrow, and so forth. So it's a 5, 6, 7 minute watch. I think I can promise you'll learn a lot.
Maximus said they need to universally do 2% or less. The banks are robbing more than enough. It'd be interesting for what I would suggest is looking up how secondary mortgage markets work. That might help give you an idea of where are interest rates coming from. Because keep in mind too that if mortgages are only providing 2% interest, who's giving that money? Who's providing the money at 2%? Are you going to be giving somebody a loan at 2% interest? That's all you want paid back. You're going to give them $300,000 and you only want 2% interest. It might be interesting to take a look at when you're looking at secondary markets and how they work, because somebody has to get paid for providing the risk for that. And so if it's just set at 2%, for instance, well, inflation is higher than that. And so you're actually going to be losing money every single year if you offer it at 2%. So having a larger picture of what's happening can, I think, help interest rates to make a little bit more sense, because banks don't just profit all of the interest. All of that money actually goes to investors who are supplying that money. It increases the velocity of money because that money turns over, exchanges hands. And what ends up happening is actually a lot of people, their retirement plans can benefit from mortgages as well, because a lot of the profits that come from there go into things like people's pensions or retirement accounts. So it's not some magical person hoarding all of this money that they get from interest and they just jack it through the roof because they want to. It really isn't as lucrative as it might seem. Closing my home this March, 6.75. What rate do you recommend refinancing?
This is a very common question. I can probably show you these are emails I've gotten so far today with people looking to refinance and so forth. So it's the number one question.
Did you print out your emails?
I print them. Well, these are loan estimate. I won't show you that because it might be. I print out usually the first page. I throw it here to make sure I do it for the day, because I get about 500 emails a day. But I'll put it this way: there is no shut up over there. We got printer. I had to buy more paper the other day because we ran out. I get one ream at a time and it lasts us for a couple months. But okay. There's an old wives' tale that says, you need to reduce your rate by 1% to make it make sense. I don't know where it came from, because I'll kind of throw the question back to you a little bit. How much money are you looking to save? Okay, so here's what I mean. If it's $1 million loan and you can cut the rate, 0.5%, you're probably going to save a lot of money. But if it's an $80,000 loan and you cut the rate a half, you might save, $10. It's not worth it. So how big of a loan is it is one of the big things there. Here's one thing I would suggest a lot of people do when you do go to look to refinance. A lot of people are struggling with the payments. I get it. But if you can afford the payment that you're paying now, possibly when you look to refinance, here's one of the options I give everybody. Why don't we keep your payment the same and see how quick we can pay off your house? That's an option for you. And then we can customize your term basically to that if you want. Or what we could do is we can close you back on a 30-year term, but we can provide you with an amortization schedule to say, well, if you made this payment each month, this is how fast your house will be paid off. Because if you go back all the way to a 30-year term, it's resetting everything. You're going to pay tons and tons and tons of interest on top of it already. But that's what you might want to look at. But a lot of people have just bought over the last year or so. So, would I do a 29-year versus a 30-year? Maybe not. But there's a lot of things to look into when it comes to refinancing. It's just not the rate alone is what I'm kind of getting at. Mm-hmm. So hopefully that answered your question in kind of a roundabout way.
Yeah, that's a good point. Well, I think a lot of people do the 1% because it's easy to remember, and it's it feels good to be like, here's a clear answer. But unfortunately,
he's at $750,000. So even a 0.5% helps. And Raul, shoot me an email. Everybody there's a lot of emails that we're going to get today, but these are questions.
I know Dan's going to use up so much paper.
Yeah, I'll answer. Yeah, I just bought a whole box full, so there's thousands in there. We're okay. We'll keep it at that. But I'd love if let's say the savings isn't enough right now, we can put you into a system to alert us that if it goes down even a quarter more, we can get an alert and reach out to you.
And if you don't subscribe, Dan will ship you VHS copies of his videos every morning.
Boiler room. Hey, somebody looked it up. Didn't you see?
I did. I saw that they said the Boiler Room cast is stacked. I'm going to have to watch it.
I'm going to say
he might be onto something there. Christina said, hello guys, I'm in Austin thinking about getting into a bigger home. Concentrating with new builds, just uncertain if now is the time to do it or wait if the market is on a downtrend out here. So here's my thought when it comes to timing on the prices. Is things like Austin, those bigger markets, they're a little harder to tell because those markets are going to have bigger swings. They're more volatile. However, for most markets, if you take a look at, actually I can pull it up really quickly, median home price here. Okay, if we take a look at the US median home price, these charts are always so annoying to use. So when we take a look at price decreases that have happened, we can see there was one here, there was this period of time. There's a period of time up here. This is when we saw, kind of the pinnacle 2008 housing crash. We saw this period of time, and then we saw a little dip here as well. So through each of these downtrends, let's assume that you bought at the height. So you bought at the height here and then waited. How long does it take you to effectively break even, right? After these crashes that happened in the market. So, if you bought at the height of 1990, if you bought at the very top, it would take you from 1990 to, what was the number here? 126, so it would be right here, 3 years to break even. So I think what people feel like is they're going to buy high and the market's going to crash and they're going to lose everything, right? And if we take a look at, if you bought at the very height here of 2007, so the median price was 257. Well, how long did it take to get back to that number, 250 to 2013? Okay, so you're looking at 6 years. to get back to the even point here. And same up here. This is a shorter time. What is this, about 3 years? 17 to, 3 years here. So on average, between the two, you're looking at 3 years, 3 years, 6 years. On average, it's probably about, 4.5 years of a break-even point. Again, if you bought at the height of these markets to break even, where you didn't lose any money, you only lose money if you bought up here and then you sold down here, which, is not super likely that you're going to be doing that. And again, this one was a completely different financial circumstance in the US, and there's a lot of protections to prevent this type of event from happening again. So all that to say, I know it feels like there's a lot at stake here, but for most people, they're going to be in their home for 7 to 10 years on average. Well, that's longer than each one of these events here that have happened. And so all I'm trying to say here is that we can see through the historical data that if you bought at the height, and the longest you had to wait, even with the 2008 housing crash, was 6 years, where you didn't lose any money by owning that home in the sales price by selling it, then you ended up okay. All that to say, it's possible that the market may go down in your city after you buy. Is it likely that it's going to have a crazy price reduction? It's not likely. It's possible that it may decrease a little bit, and that's okay. But over time, that's what we're looking at real estate. Real estate's a long-term play. It's a 5, 10, 15-year play. It's not a 2 weeks my home price decreased and all of a sudden things turned out poorly. It's similar. Think of it similarly to, real estate is not, I don't think a primary residence is an investment. I don't think you should have it, as this is my retirement plan. But for instance, my retirement account, I'm not looking at it every single day because I don't need that money until I'm planning on retiring in the future. And that's years and years away. So I'm not going to obsess over, okay, the market took a little bit of a decline and things are all of a sudden in trouble and things are at risk, because I don't need that money for a long time from now. And investing historically is all about long-term growth over a long period of time. Did something come up? Oh, I should fax you. Yeah. So I'll get off my little soapbox here, but
I wasn't laughing at you.
No, you're good.
My apologies.
All that to say, I hope that adds some level of comfort to it, that you don't have to feel like you have to get in at this right time, because everyone's been trying to do that in real estate for the entirety of time. Everyone's trying to figure out how to get into markets at the right time. And it's just not something that's possible. Investors, the best investors, don't have higher probability of getting at the right time more than a coin flip. It's like slightly over 50% for some of the best hedge fund managers. And so there's better strategies when we're looking at spending our money wisely and making wise financial decisions than timing the market. So I hope that helps a little bit. And yes, you should fax Dan. That's the best way to reach.
That's what I was laughing at. So somebody, if you guys haven't seen it, somebody put in there, should I fax Dan instead? It's like, okay, I get it, guys. I get it.
It's just funny when you're like, I got all these emails here, and it's sheets of paper.
I know. I just had to.
I want to see how many texts you have printed out.
My VHS machine broke last night and I couldn't watch movies, and that's why I'm mad today. No, I'm just kidding. So, I do print out. We print out here because there's some things I might have to wet sign or whatever. So
I get it.
We go through probably 4 or 5 pieces of paper a day, believe it or not.
Yeah.
All right. So
it's just all in good fun. All in good fun.
Here's the intriguing thing about a lot of the questions we're getting. And I talked to a young man this morning too. He's looking to buy a house, and he was kind of just I don't know if I should buy. And I'm like, here, when I bought my first house, I was ecstatic. And I'm like, if you're not like enthused about it and whatever, why are you doing it? So don't think you have to have a house, folks. If you're watching this, you're probably intrigued to buy your first house. I'm not here to talk you out of it, but we're not here to say everybody needs to have a house. That's the one thing. We're here to help guide you financially. And a lot of times, like I'm reading some of the questions is, how do I know when I'm ready to buy a house, and is it worth doing that? So I'll say it this way. How do you know when you're ready? Well, maybe you won't know. but go through, some of the steps. And Kyle has a 6-month plan, to how to buy that first house and what you need to do and so forth. Um, you know, maybe just think about it a little bit longer and put some things to paper and fax it to yourself. I'm just kidding. Is, the pros and cons about buying a house, and the expenses and things like that. And, so figure out, the finances behind it, because it is a huge financial, thing that you're doing. You're going to be buying the biggest asset in your whole life, but you're going to have the biggest debt in your whole life as well. So be careful with what you're doing. No, don't just jump into it and hopefully it works. I see all these videos on a daily basis. I should have never bought, and my regrets and all this. And if you really watch the videos and watch what happened behind the scenes with a lot of the people, they should have never bought in the first place. They bought it unseen, or they way overpaid because of this and that, or they didn't do research. They just whatever. So it's the biggest investment, and plus the biggest burden you're ever going to have in your life. Be careful is all I'm going to say.
I like it. Tira said, can you explain building versus an inventory home? I've never heard it called that. Building versus an inventory home, and how that works with a loan. Does your rate float while your house is being built, or do you lock in your rate? So there's a couple different, when it comes to new builds, there's a couple different ones that it can kind of be a little confusing. So the term most often used is a new build versus if you were getting something like a construction loan. So a new build is something like you went to, like a really popular one is like Ryan Homes. You went and you saw a, what's it called? Like a demo. Yeah.
Spec home?
I was gonna say a demo home and I was blanking. You go and you see like a spec home. So you might walk through it and you're with a sales rep and they're talking about here's what you could have and here's all the add-ons and options and features. And then you say, I want that. They go and build it. And then you purchase it just like you would any other home that's currently on the market. It just so happens that Ryan Homes or the builder, whoever that was, they're the ones who are actually financing the construction. And usually what ends up happening is you have to put down a pretty sizable, like earnest money deposit up front. Usually is going to be, I know I've seen some are kind of like a flat rate of around $10,000. Some can be different, but they want you to have some sort of skin in the game, but you don't have to finance the construction because they know that if for some reason you end up backing out of it, well, they have your earnest money up front deposit that they can take for that, and then they can also go and sell it to somebody else. So they take on the risk of the construction. However, there is custom construction. So this would be like a full construction loan. And so there's a couple different types. There's one-time close construction loans where basically you would close on the loan up front. And then what happens is the lender is going to actually pay draws to the builder over time. So they're going to give them chunks of money, inspect the home, chunks of money, inspect the home until it's completed. There's also options where there'll be loans for the construction portion. And then after the construction, when that's fully finished and you have the certificate of occupancy, then there's going to be what's called an end loan, which would be a traditional loan afterwards. So I know there's a lot of options in there that can be a little bit confusing, but for most people, if you're looking at like not a custom built, like I don't know what to call it, like a pre-built home, something like a Ryan Homes type thing, then you don't have to have a different type of loan. You don't really need a construction loan. Versus construction is really for custom construction that the lender is going to be paying your builder in draws through the process.
Good explanation.
Thank you. Let's see. Hey guys, I have a question about refinancing. I live in Carmichael, California. I bought it in 2022. My rate is 6.5. I think my house is appreciated. I also want to get some money to pay my credit card debt. Sweet. Go ahead and take this one, Dan.
So, there's a difference between the equitable equity or the usable equity in your home versus just equity in the house. So I'll put it this way. The house you have, you could probably go about 85% and do a cash out refinance. Okay. And you could do that on a primary loan, which I wouldn't suggest because you have 6.5 now. So I wouldn't do it there. Or you can do a home equity loan. Some home equity loans go up to like 90%. So It depends. What I would do is I would look up your house value on like Zillow or something like that, and then figure out, go, 85 or 90% of that, and then subtract out your current mortgage balance, and whatever is left over, that's how much equity you would have to kind of pay off credit card bills and things like that.
Mhm.
It's not time just yet to refinance because the rates aren't down there yet for you. But that's how to figure out the equity, how much usable equity you have in your home. So that's how I would kind of approach that. But it's not time for you to do anything yet because of that rate. And check and see if you have any equitable equity that you can use to pay off those credit cards. That's where a lot of people they're like, I have a $50,000 in equity in my home, but then when you do all the math, you got like maybe 8,000 a lot of times. So there is difference in the equitable, how much equity you can pull out.
Yeah, and what you might want to do is get a rate for a home equity loan and see what that is. It's probably going to be pretty high. They're going to be higher, much higher than a normal rate. Versus, we could give you a quote for a cash out for the whole thing. And my assumption is that the cash out rate is probably going to be a touch higher than 6.5, but maybe a better option than having 6.5 and then a home equity, depending on how much you're looking at pulling out, a home equity loan for what, 8.5, somewhere around there.
Well, I mean, prime's 8.5, so a lot of it is prime plus, maybe 1, 2, or 3%, depending on your credit scores or whatever. So you're probably looking at 9 to 12.
Yeah.
Rates.
So the cash out may be the better option, and I will say that this can be a really great way if people are watching and they already have a home, and you have a lot of credit card debt that's getting difficult to manage, because credit card debt is this cycle where it gets to a point where it can be almost impossible to pay down over any sort of reasonable amount of time because of how high the interest rate is. A lot of credit cards are up in the low 20% ish range, some even higher to the mid 20% range. And then as that keeps increasing, it's sometimes all you can cover is just the interest payments on those, and it's like this never-ending cycle. And so for a lot of people, they have this option to do what's called a debt consolidation refinance. And that's where you're using exactly this strategy, your equity in your home, to help pay off that high interest debt. And basically you take unsecured credit card debt at a high interest rate, you absorb it into the mortgage. So now it's secured debt with a much lower interest rate, right? I'd rather pay 6.5 on credit card debt than I'd rather pay 10% on credit card debt than 23% on it. One thing I would just keep in mind is, if you do this strategy, is continue making the same payments that you were on your credit cards as you do on your mortgage. So if your credit card minimum payments were, let's say, I don't know, usually people do this when they have pretty high credit card debt. So if you had credit card payments monthly that were, let's say, $800 a month, I would continue after you make that consolidation refinance, continue making that $800 a month payment into the mortgage principal, because you don't want to take your credit card debt and stretch it over 30 years, because you're going to still pay a lot of interest over that time. But if you pay your credit card amount into the mortgage, you basically pay it down a lot shorter with a lot less interest, because it's a lower interest rate. And then after, we can help you with the calculations if you want to. You should be able to pay off your credit card debt a lot faster, and it will also help save you money on your mortgage as well. So it can be a really great strategy to help kind of get you out of that situation where you're feeling overwhelmed by credit card debt, like a lot of people are. Let's see.
I just guest chatted you with a link to a YouTube video I did just recently, and it was remember I did a refinance video about 3-4 months ago, and I'm like, dude, it was a great video, and we got like 3 hits. There was more than that. I said it on a video, and everybody's like, yeah, it was a great video, but just bad timing. So it might be good timing now. Man, I always look like I had a little too much to drink, don't I?
Let me get you a better frame here somewhere. Oh, we got glasses Dan in there.
Here, I'll put them on now. It's just to prove it's me.
Yeah, that might be a
they?
good one. A good one to check out. Okay, so while we were doing this, I came up with a better way to reach out to Dan other than fax. I know everybody wants to fax Dan. Here's a better way to ask us questions. So obviously we do these streams where we answer questions, and we do these once a week. But another way that you can ask us questions, if you're like, a lot of people have a question before they want to get started. What you can do is just click this button right here. I have a question. And so that's going to come into us. And Dan does them more than I do, but we'll be able to reply to your question actually with a video. So we'll send a short video back answering your question. So that's a great way, if you have a question before you're ready to get started, to reach out to us. Because we do the video, it usually is going to take a day to 2 business days to get back. If you want to reach out to us faster than that, I'll put both of our emails here in the chat. Dana@rate.com. If you'd like us to, here, I'll throw these up here. So that's mine, and this is Dan's. And then again, if you'd like to go ahead and get started with a pre-qualification, you can go to whenthehouseyoulove.com, and we'd be happy to help out. Again, there's no obligation; it's free. And so, we're not going to sit there and harass you all the time like a lot of loan officers have been doing recently, where they just like incessantly call and text for some reason. So we'd love to help you with your questions and getting pre-qualified. We can help you take a look at all different types of loan options, whether it's conventional, conventional, FHA, VA, USDA. We do non-QM, DSCR loans, investor loans. And we also have a grant, 4 different grant programs that on that call we can help you take a look at. Is there federal money available for you that we can help you get access with for your home purchase? So thank you all for being here. We'll be doing this stream same time, same place next week, 3:30 Eastern on Wednesday. In the meantime, feel free to leave us a comment. We can answer that. Send us an email. Ask us a question on the website. Schedule a call. Tons of ways that you can reach out to us, because I know we couldn't answer every single question on the stream. But thank you all for being here, and we'll see you all next week.
Thanks much, folks. Thanks for coming. Bye-bye.